Bitcoin just hit $90,000, and everyone's talking about $100,000, $200,000, even $500,000 predictions. But there's a scenario nobody wants to discuss, because it doesn't get clicks, it doesn't sell courses, and it definitely doesn't pump your bags. What if Bitcoin crashes in 2026? And more importantly, what are the actual data points suggesting this could happen? Stay until the end, because I'm going to show you the exact on-chain metrics, macroeconomic indicators, and historical patterns that suggest 2026 could be very different from what the bulls are predicting. And no, this isn't FUD. This is what the data actually shows when you stop listening to influencers with affiliate links. Let's start with something most people don't want to acknowledge. Bitcoin moves in 4-year cycles tied to the halving. This isn't speculation, it's observable historical data. The halving occurs approximately every 4 years, reducing the block reward miners receive by 50%. The first halving happened in November 2012. Bitcoin was trading around $12. 18 months later, in April 2013, it hit $266. Then it crashed 70% to $65. The second halving was July 2016. Bitcoin was around $650. 17 months later, December 2017, it peaked at $19,891 according to CoinGecko historical data. Then it crashed 84% to $3,122 by December 2018. The third halving happened in May 2020. Bitcoin was around $8,800. 18 months later, November 2021, it peaked at $69,000. Then it crashed 77% to $15,476 by November 2022. See the pattern? Every single cycle, Bitcoin peaks roughly 12 to 18 months after the halving, then crashes 60 to 85%. The fourth halving happened in April 2024. That puts the potential cycle top somewhere between April 2025 and October 2025. We're in January 2025 right now. If history repeats, and there's no guarantee it will, but 3 cycles is a pattern worth respecting, Bitcoin could top out in the next 3 to 9 months and spend most of 2026 in a brutal bear market. But let's not rely on just historical patterns. Let's look at what the data is showing right now. According to Glassnode's MVRV Z-score, which measures how overvalued or undervalued Bitcoin is relative to its realized value, Bitcoin entered the orange zone in late December 2024. This is the zone where previous cycle tops have occurred. In 2013, 2017, and 2021, when MVRV Z-score hit this range, Bitcoin peaked within weeks or months. As of early January 2025, the MVRV ratio sits at approximately 2.3, according to Glassnode data. In 2021, it peaked at 3.7 before the crash. In 2017, it peaked at 4.8. So we're not at extreme bubble territory yet, but we're definitely in the danger zone where retail euphoria starts driving prices detached from fundamentals. Now let's talk about exchange flows, because this is where it gets really interesting. According to CryptoQuant data, Bitcoin reserves on exchanges have been declining throughout 2024, hitting multi-year lows around 2.3 million Bitcoin. The narrative is bullish. Less Bitcoin on exchanges means less selling pressure. But here's what people miss. Exchange reserves also declined dramatically in late 2020 and throughout 2021 as Bitcoin rallied to $69,000. When did exchange reserves start increasing again? In November 2021, right at the top. Why? Because smart money was depositing Bitcoin to exchanges to sell into the retail euphoria. We need to watch exchange net flow data very carefully in the coming months. If we start seeing sustained net inflows to exchanges, especially to major exchanges like Binance, Coinbase, and Kraken, that's institutions preparing to sell. According to Glassnode's exchange flow data from late December 2024, we've already started seeing sporadic days of significant inflows, including one day with over 20,000 Bitcoin deposited to exchanges. One day doesn't make a trend, but it's worth monitoring. When exchange inflows become sustained over multiple weeks, historically that's been a precursor to major price drops. Now let's discuss the elephant in the room that nobody wants to talk about, macroeconomic conditions in 2026. Bitcoin has never experienced a real recession during a bull market. Think about that. Bitcoin was created in 2009, after the financial crisis. It went through bull runs in 2013, 2017, and 2021. None of those years had a recession. But the economic setup going into 2026 looks increasingly precarious. The Federal Reserve's own projections, published in their December 2024 Summary of Economic Projections, show GDP growth slowing to 1.8% in 2025. Unemployment is projected to tick up to 4.3%. More importantly, the yield curve, which has been inverted for much of 2023 and 2024, is finally starting to normalize. Historically, recessions don't happen during yield curve inversion. They happen 6 to 18 months after the curve uninverts. According to Treasury.gov data, the 10-year minus 2-year spread went positive again in September 2024 after being inverted since July 2022. If historical patterns hold, that puts a potential recession window right in the middle of 2025 into 2026. And if you think Bitcoin will hold up during a recession because it's digital gold, you're ignoring what actually happened during the only real market stress Bitcoin has faced. In March 2020, when COVID panic hit and the S&P 500 dropped 34%, Bitcoin dropped 63% in a matter of weeks, from $9,100 to $3,800 according to historical data. Bitcoin sold off harder than traditional risk assets because when liquidity gets tight, people sell their most speculative holdings first. If we get a recession in late 2025 or 2026 with rising unemployment and tightening financial conditions, Bitcoin isn't going to act like a safe haven. It's going to act like the speculative tech asset it actually is. And that means significant downside risk. Let's talk about Bitcoin ETF flows because this is where the narrative gets really interesting. The bulls point to Bitcoin ETF inflows as proof that institutional adoption is here and Bitcoin can only go up. And yes, ETF inflows have been substantial. According to Bloomberg ETF data, Bitcoin spot ETFs accumulated over $100 billion in assets under management in their first year. But here's what you need to understand about ETF flows. They're not one-directional. The same institutions that bought Bitcoin through ETFs in 2024 can sell just as easily. In fact, selling is even easier because it doesn't require moving Bitcoin around on blockchains or dealing with custody issues. It's just selling an ETF share. We've already seen this dynamic play out in other commodity ETFs. Gold ETFs, for example, saw massive inflows in 2020 and early 2021, then massive outflows in late 2021 and 2022 as the Fed started hiking rates. According to World Gold Council data, gold ETFs lost over 400 tons of gold, roughly $25 billion in value, during the 2022 outflows. What makes anyone think Bitcoin ETFs won't follow the same pattern? If macro conditions deteriorate, if stocks start falling, if the Fed has to hike rates again due to inflation resurging, those same institutional allocators will sell their Bitcoin ETF positions to raise cash or rebalance portfolios, and when they sell, the price goes down. Simple supply and demand. According to ETF.com flow data from late December 2024, we've already started seeing some days of net outflows from Bitcoin ETFs. Again, a few days don't make a trend, but it's worth watching. If we start seeing sustained weekly outflows, that's the signal that institutions are rotating out. Now let's discuss miner behavior because this is a crucial piece most people ignore. Bitcoin miners are forced sellers. They have to sell Bitcoin to pay for electricity, equipment, and operational costs. After the April 2024 halving, miner revenues got cut in half overnight. According to blockchain.com data, the total Bitcoin mined per day dropped from approximately 900 Bitcoin before the halving to approximately 450 Bitcoin after. But electricity costs didn't drop, equipment costs didn't drop. Miners are now under significantly more financial pressure than they were pre-halving. What happens when miners are under pressure? They sell more of their reserves. According to CryptoQuant's miner reserve data, miner balances have been declining throughout the second half of 2024. Miners held approximately 1.8 million Bitcoin in early 2024. By December, that number had dropped to around 1.7 million Bitcoin. That's 100,000 Bitcoin sold by miners, worth roughly $9 billion at current prices. This selling pressure has been absorbed so far by ETF inflows and retail demand. But if demand slows down and miner selling continues or accelerates, that's a recipe for price decline. The miner capitulation cycle is something to watch very carefully. In previous bear markets, Bitcoin didn't bottom until miners capitulated, meaning the least efficient miners shut down and stopped selling. According to hash rate data from blockchain.com, we haven't seen hash rate decline yet. In fact, hash rate keeps hitting new all-time highs, currently around 700 exahash per second. High hash rate means lots of miners are still profitable and still selling. When hash rate starts declining significantly, that's actually a contrarian bullish signal because it means the weak miners are capitulating. But we're nowhere near that yet, which suggests more miner selling pressure is coming. Now let's talk about one of the most important but least discussed metrics, Bitcoin's Pool multiple. This metric looks at miner revenue relative to historical averages. When the Pool multiple is very high, it means miners are making exceptional profits relative to history, which often coincides with cycle tops. When it's very low, it means miners are struggling, which often coincides with cycle bottoms. According to Glassnode's Puel multiple data, the metric spiked in early 2024 around the halving, reaching approximately 1.2. It's since declined to around 0.6 in late December 2024. This is actually below the historical average of 1.0. What does this tell us? Miners are not in a euphoric profit-taking phase yet. They're actually in a moderate revenue compression phase due to the halving. If Bitcoin price rallies significantly from here, say to $120,000 or $150,000, miner revenues would spike dramatically, and the Puel multiple would flash warning signals that we're in bubble territory. But if Bitcoin price stagnates or declines from current levels, miner revenues stay compressed, which leads to more forced selling, which creates downward pressure on price. It's a potential negative feedback loop. Let's discuss retail sentiment because this is crucial for understanding where we are in the cycle. According to the Crypto Fear and Greed Index from alternative.me, sentiment in late December 2024 was in the greed zone, sitting around 72 out of 100. This isn't extreme greed yet, which typically hits 85 to 95 before cycle tops, but it's definitely elevated. More importantly, Google Trends data for Bitcoin searches shows we're nowhere near the search volume levels we saw in late 2021. In November 2021, Bitcoin search interest was at 100 on Google Trends, the maximum. In December 2024, it was around 45. This tells us retail FOMO hasn't peaked yet. The taxi driver isn't asking you about Bitcoin yet. Your uncle at Christmas dinner isn't telling you about his crypto portfolio yet. From a contrarian perspective, this actually suggests we could have more upside before the top. But here's the thing about retail FOMO. It happens fast and burns out fast. When Bitcoin search interest spikes to 80 or 90 or 100 on Google Trends, that's often within weeks or months of the cycle top. And once retail gets burned, they don't come back for years. According to Coinbase's own quarterly reports, retail trading volume spiked in Q4 2021, then collapsed in 2022, and stayed depressed through 2023. It only started recovering in Q4 2024. If retail gets burned again in a 2025 or 2026 crash, that could mean 3 to 4 years of depressed retail interest, which means depressed price action. Now let's talk about what almost nobody discusses, Bitcoin's correlation to tech stocks. According to data from YCharts, Bitcoin's 90-day correlation to the Nasdaq has been consistently above 0.6 throughout 2024, meaning Bitcoin moves in the same direction as tech stocks about 60 to 70% of the time. Why does this matter? Because if tech stocks crash, Bitcoin likely crashes with them. And there are several reasons to think tech stocks are vulnerable in 2026. First, valuations are stretched. The Nasdaq's price-to-earnings ratio is around 35 according to Morningstar data, well above historical averages of 20 to 25. Second, the Magnificent Seven stocks, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, which drove most of the market's gains in 2023 and 2024, are all trading at premium valuations. If earnings disappoint, if AI spending slows down, if regulatory pressure increases, these stocks could pull back significantly. Third, interest rates matter. Even though the Fed cut rates in late 2024, the 10-year Treasury yield has been creeping back up. According to Treasury.gov data, the 10-year yield was at 4.6% in early January 2025, up from 3.8% in September 2024. Higher interest rates pressure tech stock valuations because future cash flows are worth less when you discount them at higher rates. If yields continue climbing, either because the Fed pauses rate cuts or because the bond market demands higher yields due to deficit concerns, tech stocks will face headwinds. And if tech stocks face headwinds, Bitcoin faces headwinds. Let's discuss the supply dynamics because this is where the bull case pushes back. The argument is simple. Bitcoin has fixed supply, demand is increasing through ETFs and institutional adoption, therefore price must go up. Supply and demand, basic economics. And yes, Bitcoin's supply schedule is fixed. According to blockchain.com data, there are currently around 19.8 million Bitcoin in circulation out of a maximum 21 million. The remaining Bitcoin will be mined over the next 120 years at a decreasing rate due to halvings every 4 years. But here's what the bulls miss. Supply isn't just about new issuance, it's about existing holders' willingness to sell. According to Glassnode's H. Odell Waves data, approximately 68% of Bitcoin supply hasn't moved in over 1 year. That sounds bullish, lots of strong hands holding. But that 68% number was also around 65 to 70% in late 2021 before Bitcoin crashed to 77%. Why? Because when price goes high enough, even strong hands start selling. A Bitcoin bought at $10,000 and held through $40,000, $50,000, $60,000 will eventually be sold at some price. Maybe it's $80,000, maybe it's $100,000, maybe it's $150,000. The point is, supply isn't just the 450 Bitcoin mined per day. It's the millions of Bitcoin held by early adopters, miners, institutions, and even countries that could come to market if price reaches their sell threshold or if they face financial pressure. According to Arkham Intelligence wallet tracking, there are over 2 million Bitcoin sitting in exchange wallets right now. That's Bitcoin that could be sold at any moment. Add in the approximately 1 million Bitcoin held by long-term holders who might sell if price doubles from here, and you have significant potential supply overhang. Now let's talk about the regulatory risk that could trigger a 2026 crash. The United States isn't the only major economy dealing with crypto regulation. The European Union's MiCA regulations went into full effect in December 2024. These regulations impose strict requirements on crypto service providers, stablecoin issuers, and exchanges operating in the EU. According to reporting from CoinDesk, multiple smaller crypto exchanges have already announced they're pulling out of EU markets due to compliance costs. If MiCA's implementation causes disruptions to European crypto markets that could spill over globally. More concerning is the potential for China to crack down further on crypto. China banned crypto exchanges in 2017 and banned mining in 2021. But according to Chainalysis data, China still represents approximately 10% of global crypto transaction volume through peer-to-peer networks and offshore exchanges. If China implements stricter capital controls or cracks down harder on citizens using VPNs to access offshore crypto exchanges, that removes a significant source of demand. And unlike the US, where regulation moves slowly, China can implement policy changes overnight. Let's discuss the technical analysis perspective because charts matter. According to TradingView data, Bitcoin's RSI on the weekly time frame was at 73 in late December 2024. An RSI above 70 indicates overbought conditions. In previous cycles, when weekly RSI reached 75 to 80, Bitcoin was within weeks of a major top. The 200-week moving average, a closely watched indicator in Bitcoin markets, currently sits around $48,000. Bitcoin is trading about 85% above this moving average. In 2021, when Bitcoin peaked at $69,000, it was approximately 130% above the 200-week moving average. So from a technical perspective, Bitcoin isn't wildly extended yet, but it's getting into territory where corrections become more likely. If Bitcoin rallies to $120,000 or $150,000 in the coming months, it would be well over 200% above the 200-week moving average, which has historically been unsustainable. The other technical factor to watch is volume. According to CoinGecko volume data, Bitcoin's trading volume has been increasing throughout the rally from $60,000 to $90,000, which is healthy. Volume confirms price movement. But if we start seeing volume decline while price continues rising, that's called a volume divergence and often precedes major corrections. Now here's where I need to be intellectually honest. Everything I've presented suggests 2026 could be a difficult year for Bitcoin, but there are scenarios where Bitcoin doesn't crash. Let me walk through them so you can make your own informed decision. Scenario 1. Inflation resurges and central banks lose credibility. If inflation comes back worse than expected in 2025 and the Fed is forced to hike rates aggressively again, traditional markets could crash, but Bitcoin could rally as a perceived inflation hedge. This happened briefly in early 2022 when inflation hit 8.5% and Bitcoin initially rallied. Scenario 2. Major nation-state adoption. If a country like Saudi Arabia or Japan announces they're adding Bitcoin to reserves, that could trigger a sustained rally beyond historical cycle patterns. According to reporting from Bloomberg, several countries have been quietly exploring Bitcoin reserves, though nothing official has been announced. Scenario 3. Supply shock from ETF demand. If institutional demand through ETFs continues accelerating and there simply isn't enough Bitcoin available at current prices, we could see a blow-off top well above $100,000 before any crash. The ETF structure is unprecedented in Bitcoin's history, so historical patterns might not apply. Scenario 4. Technological breakthrough. If Lightning Network adoption accelerates dramatically, or if a new Bitcoin scaling solution gains traction, that could drive a narrative shift and sustained demand beyond typical cycle patterns. These scenarios are possible, but you need to assess their probability honestly, based on current data, macroeconomic setup, historical patterns, and on-chain metrics. The higher probability scenario is that Bitcoin tops sometime in 2025 and faces significant headwinds in 2026. So what do you do with this information? First, have a plan. If you bought Bitcoin at $40,000, $50,000, or $60,000, at what price do you take some profits? Don't just hold blindly and hope. Have specific price targets where you reduce exposure. Second, watch the data I've outlined. Monitor MVRV ratios, exchange flows, ETF flows, miner behavior, and macro conditions. When multiple indicators start flashing warning signals simultaneously, that's your cue to reduce risk. Third, understand your own risk tolerance. If a 70% drawdown would financially devastate you or keep you up at night, you're overexposed. Size your position appropriately. Fourth, consider dollar cost averaging out just like you dollar cost average in. If you think Bitcoin could go to 150,000 but you're worried about timing the top, start taking 5 to 10% profits at milestones like 100,000, 120,000, 140,000. And finally, remember that Bitcoin crashes are buying opportunities if you survive them with capital. The people who got wealthy from Bitcoin weren't the ones who held through an 80% crash. They were the ones who took profits near tops and had capital to buy near bottoms. If this analysis gave you a different perspective than the Moon Boys selling you $1 million Bitcoin predictions, subscribe because next week I'm breaking down gold versus Bitcoin, the truth nobody wants to hear, including why gold might actually outperform Bitcoin in a recession scenario. And comment below, do you think Bitcoin crashes in 2026 or do you think this cycle is different? Let me know your reasoning, not just your hopium.